Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report so twisty it's like a reality TV show for REITs, and let me tell you, someone's getting voted off the island, probably with a reverse stock split parachute. This report reveals a company doing some financial gymnastics. Expect asset sales, preferred stock redemptions, and more twists than a pretzel factory. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below so you can discuss with other people. This is Wheeler Real Estate Investment Trust's quarterly report, or a 10Q, for the period ended March 31, 2025. These quarterly reports give investors an updated snapshot of a company's performance. Let's get right to the money. For the 3 months ended March 31, 2025, Wheeler REIT pulled in about $24.2 million in rental revenue, down from $25.7 million less coming in the door, which can definitely impact their operations. Looking at expenses, property operations cost them around $8.19 million, about the same as last year. So while revenue is down, they are keeping costs pretty stable. The operating income, which is revenue minus operating expenses, is about $12.1 million last year. That's a good increase. However, this jump is largely thanks to gains on disposal of properties. So they sold some properties to make more money. We need to keep an eye on this strategy to see if it's sustainable or a one-time boost. The net income attributable to Wheeler REIT, essentially their profit, is about $3.5 million. Last year, they actually had a loss of about $18.7 million. Turning a loss into a profit sounds great, but it is important to remember where that boost actually came from: selling properties and not increased revenue. The loss per share, that's how much money the company lost or gained per each outstanding share, is negative $22.41,000 per share. Keep in mind the reverse stock splits changed the share quantity. The weighted average number of shares used to calculate that loss is way up at 3 or 5,602 compared to just 4,371 last year. Why so high? Share dilution. They've issued a ton of new shares. On their balance sheet, real estate net is worth $51.14.5. $14.5 million is a big chunk of their assets. Their loans payable, what they owe to the bank, is at $472.8 million. That is the majority of the company's debt, so paying it off or managing to refinance is essential. Cash and cash equivalents looks good, about $19.2 million. Finally, let's check their cash flow, the actual cash coming in and out of the business. Net cash provided by operating activities, the actual cash the business brought in, is $4 million from $2 million from last year. Overall, the cash is down by $13.7 million. Interestingly, there is an exchange of preferred stock to common stock item, which means stock was being exchanged, valued at about $4.3 million. The company's scheduled principal repayments are pretty high, with the majority having to be paid by the end of 2030. The fair value of warrants uses a valuation technique that relies on a lot of internal assumptions and some observable market indicators. The company also has commitments and contingencies that one should look into. There are ongoing legal battles that could cost the company money and distract management. Shareholder litigation is a common theme when a company doesn't perform well. It all ties to the Series D preferred stock redemption, and this suit alleges breaches of duty and unjust enrichment by current and former directors, potentially leading to significant costs for defense, indemnification, and liabilities. Rent expense was relatively stable at $0.2 million for both periods. There are some related party investment with SAI, so the management and investment fees must be paid. Digging into what actually makes up their revenue, base rent still makes up the largest portion, followed by variable lease revenues such as expense reimbursements. The document mentioned they have done reverse stock splits multiple times, which is something done when the company wants to artificially increase the stock prices. Series D preferred stock redemptions resulted in decrease of equity. There was an adjustment for the non-controlling interest in operating partnership, which means there was an adjustment in how much of the company was owned. This is a sign of business structure changes. There were liabilities associated with assets held for sale. This is probably a good indicator that the sales are in the plans for the near future. The fair value of long-term debt is really important because you always want to have more assets than liabilities. They have been exchanging preferred stock for common stock. It's generally something they do to clear preferred stock at better than market prices. The Cedar acquisition is mentioned as having occurred in 2022, so the company is still trying to stabilize itself by getting rid of properties. New accounting rules are expected to have no significant impact. The Series A and Series B preferred stock, common stock, in addition to the retained earnings, are pretty standard components of their equity calculation. As you can see here, the amount of outstanding shares for both common and preferred stock have changed a lot. Long-term debt is important to keep in mind when evaluating the company, but the company seems to be managing it. Adjustments were also made to non-controlling interest. In summary, the company seems to be focusing on streamlining operations and reducing costs, so selling assets that are not performing at 100 trade. Now, let's get a bit more opinionated. The company had the good fortune to turn a loss into a profit, but remember that much of the year's positive income was driven by the sale of assets, not by increased efficiency of profitability. That said, smart moves in selling some assets can boost their cash position now, but it's a short-term fix, not a long-term strategy. Sixth, the problem is you can only sell properties once. This is still a pretty unstable situation with high debt levels, a lot of obligations for undeclared stocks, and the risk of future changes in real estate costs. If Wheeler REIT can manage to improve their rental income to reduce their dependence on asset sales, then they might just make a turnaround. Overall, this financial report is interesting because you see the company is trying to manage itself while still facing headwinds to profitability. That's it for today's corporate decoder analysis. Now it's your turn. What do you think? Do you think they're on their way back to success? Do let me know in the comments. Also, feel free to like and subscribe to the channel so you can be informed of the next analysis as soon as they come out. See you all next time. Oh, and don't forget to check out the Discord community linked in the description.